I'm Howard Halderman. Welcome this morning. On behalf of Halderman and Farm Credit Services, glad that you are joining us today and look forward to a good discussion. Jim Minturn will be talking about the Ag Barometer here in a minute down from Purdue. And Jim was just telling me the Top Farmer Workshop. Anybody participate in that? Anybody participate? Mark did? Yeah, I think I got to speak on one of the panels, and there were over 200 people registered. And I think Jim said they had 33 states and somebody from New Zealand that watched the Top Farmer Workshop. So I think the big thing you guys got to decide is you continue to offer it with that hybrid option, or I guess this time it was also, and how you do that in the future. But anyway, we're going to talk about land values here in a second. I want to introduce the Halderman staff. We got Nolan Sampson, our business development director, Gary Bolander out of Montgomery County, Todd Litton over down in the Bloomington area, but works up into Putnam County. Gary and Todd will be your local reps. If you got questions about specifics of land values and rents here in this area, they would be the two to talk to. And Nolan just helps coordinate these kind of activities. So we had Tuesday night, we were up in Lafayette, and then Monday night, Fort Wayne. So doing a few of these around the state. But the land value or the farmland market has been pretty dynamic and just interesting. I think Benton County, Steve, did you tell me brought 15? Last night, that was a Schrader sale. We had 19,000 in Hamilton County on Tuesday and then or Wednesday, and then I think yesterday we were right at 10 in Carroll County. So pretty interesting sales results. But Halderman Company's been around since 1930. My grandfather started the business. He's the guy in the middle, and we represent landowners. So whether you farm or whether you're an absentee landowner or you are somebody who maybe banks the landowners, we represent all those sorts of folks. And you can see we do farm management, sales, and appraisals. And so if you need to know what the value of your farm is, we can help you with that. If you want to know about how to rent a farm, we can help with that as well. And the average tenure of our staff is greater than 20 years. And I think this points it out really well. Todd, you started with Halderman in 1985, and Nolan started about 2 years ago. And that's kind of how we get the average of 20. The other night in Lafayette, we had Hugh Pence there. Hugh started in 1956 with Halderman. My grandfather hired him. I never met my grandfather. So you talk about a span of years. And in the room, we had Josh Wagenbach, who just started with us 3 weeks ago. He graduated from Purdue in December. So that's how you get that average of 20. But the point would be, we have a lot of experience. So we're going to talk about farmland and the values that are strengthening today. And it's a great time to be a farmland owner. It's a good time to be a farmland seller. But if you're a buyer, it's kind of tough. No different than if you're trying to buy in the residential market in Indianapolis or any kind of. So one of the things we've talked about over a number of years is this outside driver of farmland sales. And what do I mean by that? But that would be a tax law change or potential change, maybe a farm bill change, maybe some major economic swing in farmland. Think back to the 1980s. And there's a couple of us in this room that were in the business at that time, maybe Steve. But the 1980s, there was a huge economic downturn due to a whole host of events, very high interest rates, and a lot of farms came on the market due to, unfortunately, repossessed activities that had to happen. So that was an outside driver that forced a lot of land on the market. In 2012, we had a lot of farms come onto the market late in the year because of the fear of capital gains tax increases. Didn't ever happen, but it was this fear caused a lot of folks to say, I want to sell and close this year so that we can capture the capital gains tax rate at the lower levels if possible. We had that same dynamic a little bit this past fall. Now, the interesting thing is we've got 30-some sales this first quarter, which would be up from the last couple of years. So that capital gains tax fear, while there was a few of our sellers last fall said, we want to sell and close and get it done this year, so we're under that current capital gains tax treatment. And I think that whole fear was born from the BBB, the Build Back Better bill that Biden has talked about. Hasn't passed, but in that had a number of tax changes to fund it. And one of those could potentially be a change in the capital gains tax rate. So that's kind of an outside driver. And for the first time since 2012, we saw some sales get motivated by something that would be outside the normal economic or family changes that see in agriculture today. Number of sales did improve this fall and winter. Really started in October. We had a lot of sales in November, early December, kind of quiet through the holidays like normal. And then we've seen quite a few come to the market here this first quarter. The interesting thing will be the remainder of this year and what kind of supply. I don't think we'll get into an oversupply problem. There is certainly not going to be a foreclosure or a distressed situation arise. So it'll really be a matter of, do people say we're at the all-time high, I want to sell now? That'll be what'll be interesting to see. Cropland values have been stable for the last 5 years until the last 12 months. And then they've jumped up quite a bit. That 18% is a Chicago Federal Reserve number. And that is a survey of ag bankers that they did. And that was from October to October. And I'm going to show you some statistics here in a second that would show that that might be low and lower quite a bit. Recreational timber and rural residential values are higher. So when you go out into the countryside here in Indiana, you're going to see a lot of timberland. You're going to see rural residences. You're going to see pasture land, creek bottoms, those sorts of things. All of those kind of parts of the rural landscape went up in value. And COVID was a major influence. People can work from home. As long as there was broadband, they had options. And so as a result, people made the choice. Maybe I don't want to live in a highly densely populated city like Indianapolis, and I want to be more in a rural setting in Putnam County, Greencastle area. And so we saw actually a demographic shift. The demographics had been a lot of people moving to the larger metropolitan areas, and that actually slowed down. I don't know that it changed, but it really did slow down, and rural values went up for these other types of real estate. So here's that Chicago Fed survey. It's interesting here. Iowa, the survey said it was up 27%. That's probably more representative of what we've actually seen. Indiana, the survey results were probably about 15%. And again, that's October to October. So the sales I'm going to show you here in a second are all the way through the 1st of January. But the 7th district was up 18%. And that's a pretty strong move in any asset market, and farmland especially. We haven't had too many of those years like that. Here's the Purdue Survey. Now, this is June. So you think about when they do this survey, it's all the way back in June before the 1st of July. We're going to talk about that being a big time change for us anyway in the farmland market. But through June, you saw a move back up to the all-time high values. I think on the best land in the state, 97.50 was the high 5 or 6 years ago, 2013, and we're back at that level according to this survey. These are not actual sales results. These are opinions. Both the Federal Reserve Bank and this survey are just opinions of people that are in the business like us and what they think farmland values are doing. The three different levels there: average, high quality, average, and low productivity. So one of the ways we do actually look at sales results is this WAPI analysis. That's the acronym that we use, but it's Weighted Average Productivity Index. So you can take your fields, you can go online using a software tool, online surety is what we use, but you can map that field and it will show you the average productivity index for the soils that exist on your farm. And you basically will come up with a number that could be 135.6, it could be 153, it could be as high as 180. That's kind of the highest rated soil in the state. We'll get to 180, 185. And the low could be below 100. Below 100 is going to be beach sand, something that is a muck, compromised from a water situation, something like that. So a lot of the farms we sell are in that 135 to 160 range. That would be the average in the state. But we take that WAPI, we take the sale price and divide it by the productivity index for your field. And we arrive at so many dollars per corn bushel of productivity index. And the reason I should explain that is this goes back to 2013. These are all individual sales. Each of these points is an individual sale. And so every farm is different and unique. And so you get a lot of volatility farm to farm. But the trend line is really what we focus on. And back here in 2013, previous all-time high, we were somewhere in the low $60 per bushel, corn bushel of productivity. So if you had a farm and you measured your field and it was 80 acres and it had a 153 WAPI, you took that times 62, that would be indicative of what the value would have been back at that time. So then we go into 2014, and we start the year above 60, we end in the mid-50s. So if you recall back to 2014, commodity prices started to erode, farm income started to erode, and naturally, so did farmland values. 2015, and this is always interesting to me, just a emotion probably as much as anything. In 2015, we started back above $60. And I think a lot of times in agriculture, we kind of have that mindset when the calendar changes to the new year, our focus changes to the new crop. Not that you haven't been planning for it, but you start to think about that new crop. It's going to be a good year, and optimism reigns. And we kind of see that in this chart where we start back above $60 in early 2015, but then really erode down to 50 by the end of the year when the reality of lower commodity prices and lower farm income set in. So that's the big decline. We were at the all-time peak. We saw that 15 to 20% decline, and we ended up at about $50. And then we stayed there for 5 years. So again, a lot of noise in the chart, but that trend line was right at $49 in 2016. In 2017, 48 to 52. 2018, 49 all the way across. 2019, 45 to 53. So again, a very flat line, right about $50 per bushel of productivity index. And then you get into COVID. We started the year right where we ended 2019, and that right around 50. We end toward the upper ends of the 50s. But the impact of COVID was really a lack of sales. So these are all different sale points, and the more sales volume we have, the more elongated each quarter gets on the bottom of the chart. So you see this narrow gap in Q2. Well, COVID broke in late March, mid-March of 2020. And what happened? We had 10 auctions in April. We converted them all to online only because we had to. Couldn't do events like this. And Steve and I were just talking. We did an event with Farm Credit in Columbus like this. And that was March, I don't know, 10th or something like that. It was right before the shutdown. So the impact of COVID was not a negative price impact. It was just that the market went to stop. We sold those farms in April and then did nothing in May, June, and July. So it was just a quiet time, which is not all bad, really, and as opposed to what the stock market did. But we end the year on kind of a strong note. Why was that? Well, the breach show happened out in Iowa in August. And then we started to see commodity prices creep up. We had the phase one trade deal with China. And so we started to get a little higher corn and soybean prices in the fall of 2020. And land values started to appreciate like all other assets did. Housing market started to strengthen then as well. So we get into 2021. Now you'd say, well, did we go back and start where we were? We did. But we started the year 21 in the mid-50s. But look at where we ended. This average is above $80. So remember back to 2013, it was 62. That was the all-time high. These are actual sales results. These aren't opinions. These are what we've actually done. And the jump really occurred about July 1st. So start at Q3, which would be July 1st, that's right here. If you ran that trend line for the first 6 months, it would have been flat at about 55. And all of a sudden, go through July, not a lot of sales, and we had 5 auctions in 7 days in August. Late August, early September. And we went through those, and one of them was kind of a recreational piece, but the other 4, they were all over $10,000 an acre. And I said to Pat Karst, our vice president of real estate, I said, something has changed. We've never had back-to-back auctions over $10,000 an acre. And they were in multiple counties and states. It wasn't like they were all in one location. So,
hey, Howard, maybe I missed it, but in all your data there, is that mostly tillable farms?
Great point, Steve. That is all cropland sales. So for those WAPI scores, we take out the sales of recreational land, rural residences. Yeah, we skim those out because that's what skew the data. So great point. Those are just cropland sales.
Over like 85% tillable, 80% tillable.
Yeah. So it really gives you a good picture of what cropland is doing. And so here's this document. Annual average in 21 was $71. So the previous high was 62. The interesting thing is the first 6 months were 55. So that flat 10% up kind of made sense to me, why we would see a 10% increase with better farm income. And a lot of government money. We'll talk about that in a second. The last 6 months were at $79. That jump that I talked about it was up 46%. So when that Chicago Fed survey says up 18%, I said, okay, that's probably a little light. And we had some buyers. So like I said earlier, it's a great time to be a seller, tough to be a buyer. We had a family up in Wabash County. Their father worked for my grandfather for 40 years. They know the farm real estate market. And they wanted to put some money into farmland. They bought a piece in March of 2021, paid about $7,000 for it, pleased with the purchase. It wasn't a spectacular piece of land, but they got one done. They want to put some more money into farmland, and they're trying to buy it at $9,000 an acre last fall. And I said, Dave, the market's changed. We got to be thinking 12. Well, you're kidding me. I said, no, I'm not. Look at these statistics. So that's the big change. The 20 average was 51. The 21 average was almost 71. So a big change in land market, and a whole host of reasons for that. Here's the other way to look at this is the $10,000 an acre mark. And this is something I got actually from R.D. Schrader, because these are some statistics he talked about at the Top Farmer Workshop for their sales. But if you look, the first 6 months of 21, 17% of our sales over 10,000. The last 6 months, 88%. That compares to less than 10 if you go to the previous 2 years. So big change. And then this just shows the big jump. This is last, what, 5-6 years. And it was a flat line if you draw a trend line through July. And then it's really been flat since, just at $20 per bushel. So it didn't, Pat said this the other day. He said, Howard, did we really jump from August? You know, did the price increase from August? Or did it just jump to that and then just stay there? And I think it's kind of done that to some degree, which would lead into what might happen this year. So here's a bar chart showing the same thing. Here are a number of sales. This goes back to March of last year, so about 10 months ago. And you can see that even in spite, this just shows that volatility that we talked about. 46, 47, which would be in theory below the market. 92 in Fayette County or Connorsville. This is all before the big jump. Here's Hamilton County for 15 with some development potential. We sold one in the same neck of the woods for 19 earlier this week. So then we got to July. See, not much happened June and July. That's pretty common. Summertime's a little quieter in the cropland market. And then we had these 4 sales in August that I talked about. So 14, 11, 10, and 10. 2 states, four different counties and 4 different locations, all northern Indiana or western Ohio. But outside of that, there wasn't any other consistency to it. Now I'm showing these, here's 4,300 for recreational land, but 15, almost 11. So here's a couple that Gary did. Here's the Purdue Beef Farm, 6,100. So you want to know what pastures, woods. This was a blended sale that had very little cropland in it out of the 882 acres. Cattle farm, which would be similar to what you might have down here in Putnam County in some locations. Here's 2 in the Wabash River floodplain. I know that could be an influencing factor when you get down in these parts. And the day that we sold these, and I don't know if Gary wants, I told this Tuesday night, the day that we sold them, Gary, how did they look?
Well, just say the river was pretty wide that day.
It looked wet. It's kind of bad when you have your 4x4 or 4x8 signs on the property and they're almost underwater, right? The day of the sale. That's not really an ideal marketing move. And you would think in September that wouldn't be an issue, right? Yeah, or October. But so if you have compromised land in the sense that it will flood on a regular basis, because those farms always have, that's kind of what values you might be looking at. All joking aside. You see some pretty big numbers all the way through the fall. And we had a lot of sales here. Hamilton County, $102. That's development influence. That's the halo effect of Indianapolis. And residential development causing 1031 exchange, that kind of influence. Oh, here's another one in Hamilton County, $29,000 an acre. You can say, well, that's going to have houses on it next year. No, it's zoned ag, no sewer and water. It is farmland and woods today. Group of guys not originally from this country bought it, and I don't know what they're going to do with it. We had one guy, a competing bidder, saying, at $23,000 an acre, I just want to hunt on it. So I'd come to Putnam County and probably find you something cheaper than that. No offense to Putnam County, but that seems like a crazy amount. Now, this was by Purgatory Golf Course at Clare. If you know where the Strawtown flea market is, that's about where this property is. But still, that was, we thought $15,000 an acre would have been appropriate for that. And it brings 29. And then here are the sales. These are last week's auctions that we had. So the question would be, has this market continued into 22? And between these sales and the two that we did the last 2 days, the market would argue that yes, we've continued the trend. And why would it change? Commodity prices have not declined. In fact, they've increased a little bit this year. Interest rates still are relatively low. Farm credit can speak more to that, but I think we're in a pretty good spot still. Here's what our estimate was back in September as to how the farmland market had changed. Now I show you this just to show you the diverse opinions, because I had some of our people say, oh, maybe on the best cropland only have a couple percent. Now this is early September. And then other people up 30%. So, but the other thing is woods, rural building sites, and recreation, all stronger. So it was not just cropland. Who are the buyers? Last year was about a 50-50 split for us. These are our actual sales. So when we go to an auction, the farmer is the person who's actually producing the crop. So when we call somebody a farmer, they're driving the tractor, they're doing the planting, they're taking the risk of growing that crop. The investor would be everybody else. So sometimes that's somebody like Series Partners, which is more of an investment fund. But most of the time, that's somebody from Greencastle, doctor, attorney, business person that wants to own farmland as part of their investment portfolio. So about a 50-50 split. Normally, that's a little higher toward the farm. Number of sales compared to previous years, you can see this had historically been less or the same, a low number, but we did see our staff felt like there was more in the market. Sure, there was. And then if you take dominant purchasers, and this is the question asked, dominant purchaser in your marketplace on all sales. The 50-50 split is our sales. This is all sales, which would include off-market transactions. And it's about 75-25 still. Purdue Ag Barometer, I'm not going to speak about this because Jim's going to do it here in a second. But that does influence farmland values, I think, or at least reflects where values trended, except for the last 6 months. So maybe you have some thoughts on why farmlands continue to go up with the barometer going down. Will inflation be a factor? Historically, farmland is very positively correlated to inflation. And no one will argue now that the data is in, we've been in an inflationary time for the last 12 to 18 months. And so this is kind of the prediction going forward into 22, 23, where farmland values might go depending on inflation levels. But the point would be, in all cases, it's a little stronger going forward. These are U.S. cropland values, so that's why they're not near what Indiana's would be. So farmland debt, we'll talk about this briefly. We are inflation adjusted. So taking inflation out of it, we're back to about the all-time high of farmland debt. You have a little bit more real estate debt, less non-real estate debt than what we had then. But you'd say, gosh, back to 1980, and we got the same amount of debt, inflation adjusted, that's kind of scary. Well, it would be, except our asset values are a lot higher, and interest rates. So average interest rates on non-farm real estate loans, you can see where it was up above 18% in 1980. Some of us weren't around in 1980, you're in the farming business in 80. But I was on the back end of that, where I remember a couple of people on our staff lamenting the fact that their 12 or 15% CDs were rolling off, and they were going to have to take 10. We haven't seen CD rates like that in decades. But this low interest rate is really what's making up a phenomenal difference. And how is that? Here's machinery debt service index. So this is estimated annual payments to service $1,000 worth of debt. See how high it was. It took $1,600 to service $1,000 worth of debt back in 1980, and it's taken less than $400 now. So why are we in less troubled times? So here's a great way to look at it. The blue is debt, and the orange or the red, brown is interest expense. So that's what you're writing a check for. And see, it was about equal back in 1980, but today, while debt is back where it was, the interest expense is dramatically less. Here's the debt to equity and debt to asset ratio. So I talked about asset values being higher than they were in 1980. And so when you're looking at asset values that are $9,000, $10,000 an acre versus 3 or 4 in 1980, then that total amount of debt will lead to a lower debt to asset equity ratio at a level that has been pretty survivable. Here's debt to income, and that would be your total debt divided by your farm income. It started to get above 5.5, which this was deemed the concerning. This is 1977, where it goes above 5, 5.5. That starts to be a warning sign. We got there in 2016, and had it continued to trend this way, that would have been a problem. We've been back to where we were then. But fortunately, farm incomes and debt didn't increase a lot, and interest rates stayed where they were. Here's the delinquent loans, less than 2.5%. There's still some out there, just not a high percentage by any means. This is an interesting, and Natasha Cox said Tuesday night that actually working capital as a percent of was about the same as it was a year ago, even though cash is up because the cost of production is up so high. I hadn't thought of that. That would be an influencing factor. But you see, we had really eroded working capital in the last 5, 6 years due to the low market. And here is inflation adjusted real working capital, which again is concerning. So where do farmland values go from here? It depends on these 3 things: farm incomes, interest rates, and supply. We generated a lot of cash 07 to 13, kind of like last year. Had that cash drain. We just looked at that. Government support was absolutely critical. Interest rates still historically low, and farms for sale are less than the normal. So kind of bullish factors on all 3 points, right? Farm incomes, gosh, you had some gross incomes that were over $1,200 an acre. That's profitable. Probably some farmers made $500 an acre. When I started in 1988, we sold farms for $300 an acre. Sold them. They weren't great, but there were some prices like that. Rents, $450 an acre. So while incomes were really good last year, certainly production costs are up. So here's what the USDA is now saying in terms of net cash farm income and net farm income in general, $116 billion. The thing to look at that is you go back historically, that is at the higher end of the range. So it was a good year last year. USDA payments. So when you think about market facilitation payments, CFAP payments due to COVID, there was a lot of cash that came out over the last few years. And you look at the end of this chart, 2020, fiscal year 2020 was the highest ever. This is inflation adjusted, going all the way back in the 1980s. Here's the breakdown. Blue is net farm income, orange is direct payments. And you can see the breakdown there that was a pretty significant part of the overall income picture in 2020. Didn't show 21 because the payments were a lot less and farm incomes were a lot better. If you take the government program payments out, incomes in 2020 were actually net. So when I say that was a pretty key part of support for ag, it was. And that's why when working capital got to that really low level, that a lot of farms were able to survive and continue on because of the support payments that we received. Are we going to get many in 2022? No. Prices wouldn't justify it. I don't think there's any programs that are going to get passed to provide it. Impact of trade. Briefly, China's purchases of soybeans dramatically back up after we got through the trade war. Corn, normally they don't like to import corn, but they have. And then we have the impact of fertilizer prices. And you guys all are aware of what that is. And then fertilizer as an expensive shared budget revenue. The interesting thing is it's not at the all-time high in spite of the retail sticker price on that. And then impact of timber values. Todd was just saying, you had a timber appraisal on a property and it was $5,500 an acre in standing timber value. That doesn't include the real estate underneath it. Harvestable timber today. So with residential expansion, a stronger housing market, you would get timber values moving up. Here's the cap rate in farmland. And I had said for years that 3% just kind of felt like a minimum, but we're at about 2.5% today. So gosh, that's a really low rate of return. Well, farmland is compared to other fixed income assets, which would be CDs, treasuries, and what are those? So comparatively speaking, farmland is still at a positive by 100+ basis points to those other fixed income assets. You don't compare farmland to equity stocks. Those are two different types of assets. But fixed income wise, farmland is still pretty competitive at 2.5%. The concern would be is if interest rates went up 300 basis points or 3 percentage points, then all of a sudden that flips. And CDs might be more appealing to an investor than farmland. Cash rent results, just briefly, will you increase rents? Our staff said back in September, yes, they would. That's not a surprise. A lot of rents for 2021 were negotiated in the fall of 20 before commodity prices had their full price appreciation later in the year. And so a bigger adjustment probably than you normally would have done due to higher fertilizer and input costs happened this fall to make up for some of the increase that didn't happen for 21. So there's demand for farms to rent and the market is moving stronger. Was the demand for farmland to rent for 22? And 7 of our people said more and 4 the same. It has historically been strong. I don't think there's been a time in my 30+ years of doing this that we've ever struggled in the Midwest finding farm operators. The market changes, how much you're willing to pay changes, but generally speaking, there's always good demand. Do you have any tenants in distress? And one of our people said yes. And I just throw this out here. We did 2 receiverships last year. Receiverships are a situation where a court has been asked to appoint a receiver to kind of oversee an operation to help cover the lenders, protect the lenders. So I point that out to say it isn't rosy everywhere. It's a whole host of reasons why that occurs. But there is always some degree of distress due to certain circumstances. Flex lease, we do a lot of flex leasing. I like this tool. It's a tool where the guaranteed rent is a little less than the fixed rent market. And then you might pay a bonus as a farmer, you might pay a bonus if it's a good income year. Not just yield, it's yield and price, it's revenue. And we get 25 or 33% for our landowner above a certain hurdle. And that tends to be a fair way to do leasing. So that hurdle might be as high as $900 an acre in corn and $650 on soybeans, based upon what my staff said back in the fall. That 900 is about $100 an acre higher than what it had been a year ago because of the higher input costs. So the farmer is going to get that first $900 an acre. That covers their variable costs, that covers machinery in theory, and it covers rent, fixed rent, the guaranteed part. And then anything over 900, they share with the landowner in some split, 25, 33% the landowner, something like that. So here's the Purdue Survey on cash rents. And this talks a little bit about what I was saying. Most of these rents were negotiated in the fall. And so they are at a point a little less than the all-time high, where farmland values were back at the all-time high. I think this will show a bigger increase in the survey done in June than what you might expect. Making up for it. So to kind of finish up, here are the reasons why I'm going to be bullish for the farmland values this year. I'm thinking probably another 3, 4, 5% increase on top of what we already saw last fall. You've got long-term world demand fundamentals for food. You see that impact almost immediately when day by day we track the rain in Argentina and Brazil. And that influences what corn and soybean prices are doing. So it's a just-in-time type of delivery. You know, this whole Supply chain issues are real for everybody, including food. Interest rates are still favorable. That 4.01%, that's an average fixed rate for 15-year money for farmland. That's the Federal Reserve. This is not Farm Credit. So these are the FDIC banks. And that's their average. And that is the lowest in recorded history by the Chicago Federal Reserve Bank. And it's been that for, I don't know, the last 8 quarters. Every time the letter comes out, this is the lowest ever, it says. And 4.01 was in October, the lowest reported. Supply of sales did pick up, but I don't think it's overburdensome by any means. Government support is going to be likely 0, but again, do we really need it? Is it justified? Probably not, unless you got into a disaster of some sort. And input costs are certainly rising, and there's more cash out there. So cropland values in an uptrend. I think there's going to be strength in timber recreational land. That's going to continue based upon the calls that we receive and the interest we receive. The average to below average farm would be the one to be concerned about. 80 acres and 5 fields. With today's equipment, that's kind of hard to farm. And so as a result, that might get discounted more versus the 80 acres in 1 field of the same soils. So where do we go from here? I'm bullish, as I said, for these reasons. And I just don't see a lot of that changing. The biofuels demand is remaining in place. World population growth, I think trade deals have helped, probably continue. Potential for inflation is a positive factor for farmland. Commodity prices are pretty good right now. I think if we go through February, which starts next week, that's your crop insurance price setting one of the 2 months if you choose the harvest option. But if we go through February at pretty high values, that provides the crop insurance alternative. You can lock in some pretty good coverage. And oh, by the way, you can sell. And I think Pro Farmer Rock are somewhere around 20% sold on 22 crop. So I'm not super aggressive on selling before it's in the ground, but you have the opportunity to lock in some profits today. So as a result, I think land values are going to continue to be higher. These would be the arguments on the other side. How could we get bearish? Why would land values go down? We saw a rapid appreciation. Could we lose 15 to 20% of that right off the top? You could, if a couple of things would happen. The Federal Reserve has talked about increasing interest rates. Do they do it a quarter point at a time, a couple of times, 3 times maybe this year? Or does it move up 200 to 300 basis points, 2 to 3%? I doubt that happens, but if you saw interest rates really rapidly go up because inflation remains super high, then that could be a problem. Combine that with Russia invades Ukraine. China does something with Taiwan. North Korea does something with, who knows? Those would be black swan events, would they not, Steve? Those are things you can't predict. They say, well, probably Russia goes into Ukraine over the weekend. I don't know, maybe. And that might actually have a positive influence on corn and wheat prices. But still, those are global situations we can't predict. We have no control over. But those could be your black swan things. If the RFS were to change, I don't think that's going to change a lot, but that could be a negative. So Steve and Jim can offer their opinions on that. I think the biggest thing is you got a high cost of production. And so if we saw a big decline in commodity prices for some global reason, Brazil and Argentina starts raining a lot the next couple of weeks, that could lead to lower commodity prices, low cost of production. Combine that with an interest rate increase that's more significant than what is thought, then it could be a little bearish. Otherwise, I think you're in a positive upward trend still. Questions? Questions or comments? So this just documents what I said. Our survey said 2 to 15% back in September. We've seen a lot of that already, but still will be bullish going forward.
So it's a pleasure to be here, and it's always a pleasure to have Howard start, because the thing I like about listening to Howard is he's got the real data up to date. Usually last night's sale, I think in some of the previous presentations.
That was yesterday's, yeah.
So that's always interesting to talk about. So I'm the director of the Center for Commercial Agriculture. For those of you that aren't familiar with the center, we started the center about a little over 10 years ago at Purdue. And the goal of the center is really to conduct applied research and develop educational programs and provide information on the web for people engaged in production agriculture as their primary source of income. So Purdue's always worked with people like that, but the center just provides us an opportunity and a vehicle to maybe concentrate on that a little bit more. So if you haven't tapped into our programs before, I'll have the website up at the end so you can take a look at the address. So Howard showed this slide briefly. This is the Aggiecon Barometer. This is a project we started in partnership with the CME group about 6 years ago, where we survey farmers from across the nation to find out what they think about what's going on their farms today and what they think is going to happen in the future. And we use it to create a sentiment index called the Aggiecon Barometer. So we survey 400 people every month. It's not the same 400 people around the country. We have a big database we work with, and we pull people off of that database. To maintain consistency from one month to the next, the database is stratified. So we survey people that have the same production characteristics every month. So every month in the survey, a little over half of the people in the survey have either a corn or a soybean enterprise. The next one down, I think, is beef at 19%, and so on down the line. So we survey people that produce corn, soybeans, wheat, and cotton on the crop side. And on the livestock side, we survey people that produce beef, pork, and dairy. So we don't look at other enterprises. And I guess one of the questions I often get is, what about specialty crops, et cetera? We don't target those folks at all. And so our survey is not representative of them. But it is representative month by month of people that produce the major ag commodities. The other thing we do is we focus on people that are engaged in production agriculture as their primary source of income. And the way we do that is the database is stratified. So we work with people on our survey database that have an estimated gross farm income of $500,000 up. So we eliminate the really small producers and focus on people that are more engaged on the commercial scale. And what that also does for us is allow us to survey a relatively small number of people each month and still be representative. Because it turns out when you look at USDA's definition of a farmer, the vast majority of them are very, very small. When you focus on people that have a gross farm income of 500,000 and up, that turns out that's only about 8% of what USDA calls a farmer. And so that's actually a relatively small number of people. So 400 people is actually representative of that group of people. And when you think about the index, it's plus or minus 5% at 5% confidence interval. So the barometer is really patterned after some other sentiment indexes. In particular, it's closely patterned after the University of Michigan's Consumer Sentiment Survey, which has been around since the early 1950s. And you probably see that in the business press periodically. So measures sentiment in the production ag sector. Nobody else had ever done this before. And so we were kind of excited to have the opportunity in partnership with the CME group. So as you look at the index, it starts in 2015.
Hey, Jim,
Yep.
How does this compare to crates, the thing they do?
It's quite a bit different in the sense that their sample is not stratified in any way. So they have a lot of variability in the time frame you look at. There are times when they're moving together, they don't move together as well. Ours is a little more correlated with the sentiment index, although there's times when consumers and producers die a bit. So, I have another talk about that with baseline.
Well, I know that crate data sometimes gets talked about in ag circles, so that's why I asked.
And the reason that but they survey it's like the land values you talked about, where you're talking to people that aren't necessarily, they get primarily lenders, people in small communities. And they call that the kind of Main Street index.
Right.
So ours actually produces a little bit of a contrast. The first thing you notice some volatility there. We telling us they're going to reduce their construction plans. And then finally, a few months ago, it occurred to us that we really weren't asking the correct follow-up question, which is, are supply constraints, the supply chain problems causing you to have a change in respect to your investment plans? And 45% month after month have been telling us supply chain problems are what's really holding them back. So if you think about what's going on with that capital investment index, people are telling us indirectly, we would make investments if we could buy this stuff, right? If I went to my machinery dealer and he actually had a combine I could buy, I'd probably buy the darn thing. And that's really what's taking place there.
So when you say capital investments, do you include land in that too?
So the way the question's phrased, and again, we patterned this after Michigan. So it says, is now a good time to make large investments in your farming operation in things like machinery, buildings, and grain bins. So it doesn't actually ask land. We ask about land separately, which I'll show later. So this kind of gets at what people are worried about. This is no big surprise to the people in this room, but we asked people the last few months, what are your biggest concerns for your farming operation in the upcoming year? Higher input cost is by far and away the #1 thing. In the subsequent question, we actually asked about inflation. Inflation starts to show up as well, but more broadly, people are just worried about what's going to happen with respect to input prices. We asked a follow-up question that said, are you having some difficulty purchasing inputs for your 2022 crop season? And roughly 4 out of 10 people on a couple of different surveys now have said, yeah, we're having some trouble actually buying what we want to buy for the 2022 season. And then the follow-up question was, well, what are you having trouble with? And if you look at it, everything, right? Herbicides was 28%, insecticides 17%, fertilizer 31%, farm machinery parts 24%. Supply chain across the board is a problem, right? It depends on who you are and where you are in terms of which input you're having trouble with, but people across the board are saying, this is a problem. We asked people about what they think is going to happen with respect to farm input prices. And farm input prices over the last decade have gone up an average of not quite 2% per year, about 1.8%, looking at USDA's index of input prices. So we give them that as background because some people have a little background with their answer to the question. Then we ask them, what do you think is going to happen in the next 12 months? 4 out of 10, 39% of the people in the survey said they expect to see farm input prices 2022 climb more than 30% versus 2021. If you look at the history of the index at USDA, that's never happened before. We have never seen input prices go up this rapidly in this short of a span of time. So getting back to why the barometer is showing the negativity that it's showing, it's that kind of uncertainty that's out there, right? This is uncharted territory. Yeah, 2021 for virtually everybody in the Midwest was a pretty good year. But looking ahead, with this kind of stuff going on, it creates a tremendous amount of concern about what is going to happen, not only in 2022, but a little longer term. This is based on, we asked a couple of questions directly about farmland values. We asked people about, what do you think is going to happen to farmland values in the next 12 months? And what do you think is going to happen in the next 5 years? So 2 separate questions. This is the long-term index. So this is the responses we get to what people think is going to happen in the upcoming 5 years. And we computed the index. We didn't start asking this question every month. So one of the interesting things about the survey was we've learned a lot as we've gone on. In the beginning, we thought we would ask the farmland question like once a quarter, maybe once every 6 months, because does farmland really change that much? Well, it turns out that's a more interesting question than that, right? So we finally figured that out. We started asking it every month, but we didn't do that at the beginning. So I don't have this data going all the way back to the beginning.
So how accurate were they 5 years ago?
Yeah. Well, actually, we haven't done that analysis to actually ask their forecast. The trend has been up, you can see, right? The interesting thing to me, though, is what's happened these last couple of months. And we're actually going to release new data next week. And the whole report isn't finished yet, but it's going to go down again when we release the data next month. So that farmland index has started to come down these last 3 months. That's interesting. How does that match up with what's going on with the data Howard showed?
You're asking the wrong people.
Well, what do you think? So the question says, what do you think is going to happen to farmland in the next 5 years? We've already seen farmland values skyrocket
over the last, what, 12 to 15, 18 months, right? I think people are looking at this and saying, they're not really bearish on farmland necessarily. They're just saying it's already gone up a bunch. Can it keep going up from here? I think is what we're starting to pick up. And we're picking this up on the 12-month index and on the 5-year index. So getting to your question, it's going to be interesting to see how that turns out. Yeah, Mark.
Yeah, but that's kind of like, what's inflation going to be a year from now? I mean, it is what it is based upon the 7%, right?
Yeah, right.
So it's not going to.
Yeah. So this is kind of interesting to watch what people are thinking, though. But I think actually is a little bit consistent with what you guys are picking up in these last few months of sales, where it's kind of leveled off, right? You're not seeing the rapid increases lately, but you haven't seen a decline either, right? It's just kind of leveled off a little bit. I think that's what we're picking up here. The last couple of months, we've been asking the question, what's the main reason you expect farmland values to rise? And I have to say, my co-author, Michael Langemeyer, and I were a little bit surprised by this, but I guess Howard was not, because I asked him this question a while back when we did the Top Farmer Conference. 61% of the people in the survey said their main reason they expect farmland values to rise is non-farm investors. We thought it would be a little more strongly oriented to strong farm cash flows and low interest rates. And one of the reasons we think, especially low interest rates, and Howard mentioned this earlier, we're at the tail end, it appears, of a multi-decade decline in interest rates. And going forward, that's probably not going to be supportive of farmland values, but it's been supportive of farmland values going back to the 1980s, right? If you look at that chart of farmland interest rates, with some blips, it's been declining pretty sharply for 4 decades, right? So that's a little bit of a surprise, but I think the non-farm investor, that's very consistent with what Howard put up, right? That's really been supportive. Not that they're always in there buying, but they're supportive, right? They're in there, they're bidding, they're present, providing that underlying support.
You're warming up over here?
Yeah, you bet. We do, so when we get the barometer is a telephone survey, and when we get people on the phone, we try to keep them on the phone no more than about 5 minutes, because after 5 minutes, people go click, right? Sometimes they go click before that. Survey people hate it when people, you know, the worst thing you can do to a survey provider, you got 30 questions and you answer about 28 and you hang up, because they got to start over, because that's an incomplete survey. So if you're hanging on there, just stick with it to the end. So doing the basic barometer questions each month doesn't take 5 minutes. So we ask some special questions periodically. Last summer, we asked on a couple of different surveys, we asked people about solar leasing. And solar leasing has turned into kind of a hot topic in Indiana, depending on what county you're in. So this is national, keep that in mind. This is not just Indiana. 400 people in the survey, 4% of the people said either they or one of their landlords had signed a contract to lease some farmland for the installation of a solar energy project to generate electricity. We're going to repeat that question here a couple of times in 2022. That 4% struck me as high. Maybe not high in Indiana, but as you look at other states, that struck me as high. But again, we didn't know what to expect coming in. And then the interesting thing was, we did this 2 months in a row back in June and July. We asked people what kind of rates are being offered, not for the development period, but for when the installation is complete and you're actually operational. And the number is probably a little hard to read there. So the left-hand side says less than $500 an acre. The middle, second one says 500 to 750 an acre, 750 to 1,000, and then greater than 1,000. And notice the spread there. It's huge, right? That's indicative to me of a market where we've got asymmetric information, right? The leasing companies, I think, are throwing out numbers and seeing what sticks, right? This isn't necessarily based on the value. It's based on what somebody willing to sign up for. So keep in mind, and you can see it starting to show up. I mean, 2 months of data, I'm not sure I want to put too much emphasis on this, but if you look at July versus June, it might be shifting a little towards the higher numbers, right? And in fact, when you look at and talk to people that have been in contact and actually signed contracts, The drift appears to be towards the right-hand side of that slide, with the numbers going up over time. But we'll repeat that and see how that shakes out going forward. So solar leasing is really interesting. And I mentioned that it's a hotbed here in Indiana. Indiana is in an interesting spot because we're at the western edge of the eastern grid, and we're at the eastern edge of the western power grid. And as a result, Indiana is in kind of the sweet spot for solar energy production. I mention that because every month when we release a barometer, I do an interview with AgriTalk, and AgriTalk, which is part of Farm Journal, is based in Iowa. And when we did this survey, they asked me, what possessed you to even ask these questions about solar leasing? Well, the reason we did it was because we were getting emails and questions here in Indiana about solar leasing. And they said, this is not an issue in Iowa, right? Iowa does a fair amount of wind energy, but there really wasn't much going on in Iowa with respect to solar leasing. And it's because of the way the grids are laid out. So this will continue to be an issue in Indiana. And in fact, so you might have some comments here later, Steve. To me, when I go around Indiana to do meetings, it's getting pretty controversial. Probably every bit as controversial as wind, maybe more so. I'm not sure. Seems to me like it's even more than wind, but I'm not sure about that.
Well, it's new, and it's
yeah.
I think that's part of it too.
Yeah.
Yeah.
People are very well. One of the reasons I say it's a little more controversial is because the land really comes out of production.
Yeah.
And with wind, you're still farming it, right? That seems to be what's driving some of the controversy. That's not the only.
And the solar companies want all the good flat farmland that's easy to build on. They don't want the rolling hills. And
yeah, and so you're losing the good stuff, right? And people see that, and yeah, it's been controversial.
I've got 3 or 4 farms that they've signed up. Now it's still and they've agreed on a price per acre, and it's between $750 and $1,200 an acre is what the leases are, and they've got an escalation clause in them too. It ranges from 1% to 2% per year, and the solar company has to pay any tax increase. So if the assessor comes in and says it's commercial, and they start assessing it at $150 an acre, they've got to pay the difference between farm tax and that rate for the whole thing.
50 years ago, they were talking about solar. But any of those farms sign up and are up and running, what happens when that company goes up?
Well, that's the big question. You know, that's the big unknown, because a lot of these solar companies, from the conversations I've had with landowners and stuff, is they don't want to post a bond until about year 5, 6, or 7. And so what they're saying, what the solar companies are saying is, well, if something happened to us, somebody else would pick this project up because it's a viable thing. Well, if we have that black swan event where it's no longer viable, who's going to pick that up? So the skeptic, which I'm kind of skeptical about that, says, hey, the other thing that kills me is I've talked to, so a 500-acre solar farm is going to generate about 70 to 80 megawatts of electricity a year. The Gibson Generating Station power plant at half capacity generates 1,635 kilowatts per hour, or megawatts per hour. So it's going to take 4 million acres of solar panels to replace that one generating station. So how is that going to work?
So the companies don't worry about that part. They just look at it and say, we're going to lease every acre we can get our hands on in a spot. And the big thing about this is they're all looking at the same stuff. They're looking at the infrastructure, right? So it's all about where are the existing high voltage lines, where are the substations, and then the last point, which I wasn't fully aware of until I did a presentation with one of those guys a couple of months ago. They're looking for slots on the grid, right? Yeah. An opening where they can actually access it. In other words, there's excess capacity on the grid in that location, and that's when they jump in there. And what I see going on is they're trying to lease up farmland in anticipation of slots opening up. So they're leasing farmland in places where they couldn't really build one today because there isn't an opening on the grid, but they think there will be down the road. And they want to lease that farmland in what they think are advantageous locations.
So I actually with Halderman, I represent a couple different solar companies, and we try and lease ground for these projects in Kentucky and different places in Michigan. And you mentioned what happens if the solar company goes belly up. And there's everywhere we go, there's 5, 6, 7 other companies trying to lease the same ground in the same area. And there are companies out there that don't want to post a bond until 5, 10, 15 years down the road. But it seems like the companies that are a little bit more legitimate and serious about wanting to do a project they'll put that bond in place on year one. And that's something that I even encourage when I meet with a landowner. We're going to be around a lot longer than the solar company is going to be in the area. And so as a alderman representative, I always tell them, make sure that bond's in place and go see an attorney that has seen several different contracts. And in Indiana, I don't want to advertise for anybody, but Bose McKinney, Gary Chapman in Indy, he's seen 30, 40 different solar contracts. So I usually recommend people go talk to them. But yeah, if you ever have any questions on that, my information will be on here. You can give me a jingle. I've seen a lot of different contracts too, and in a lot of different areas.
My reaction looking at this is an evolving market. And if, as a landowner, it's probably a time where you don't need to get in a big hurry, right?
Yep.
You can kind of kick back and see how this develops, but it looks to me like the rates are going to drift to the right-hand side of that chart. So it's going to be interesting to see how that develops over time. So, and the other comment I would make about companies, I've seen a little of this firsthand. It reminds me a little bit of oil leasing, because if you sign an oil lease with a company to drill a well, over time, how many times is that oil lease going to change hands?
Yeah.
Lots and lots. And that's exactly what's going on with solar, right? So pretty good chance the company that you sign with 5 years from now, somebody else is going to own that lease. I don't know that very many of these will actually be the long-term owners. We're more in the development phase. So keep that in mind. And that kind of gets at your point. That means the contract needs to be as tight and have as much detail in it as you can get, because the handshakes mean nothing, right? That person's going to be gone 3, 5 years from now. You'll never, so make sure you get everything in writing that you want.
Absolutely.
The big difference with the oil wells and the solar, though, is the oil well you've got one oil well for 20 or 40 acres, and it's kind of like solar or wind, but solar panels are going to take the whole 40 acres, or 36 and leave you 4 over here that they don't pay on because it's in a corner that doesn't work.
And one of the things you mentioned, Gary, one of the things you want to do is avoid having them checkerboard you, right? So that's one of the things you got to do.
Well, and that's another thing. Some solar companies will agree to taking a minimum number of acres on your farm. So if you've got a 200-acre farm, well, they want you to sign up an option for all 200 acres, but they don't want to have to use all of it. So sometimes you'll talk to them and they'll say, you'll say, I want a minimum of 150 acres. If I'm going to sign an option, I'm not going to have you put 30 acres right in the middle of the farm and mess the rest up. And some companies will do that and some won't. So it's just very interesting. And you mentioned sentiment in different regions. We've worked in Michigan, Indiana, Ohio, Kentucky. We're working in Idaho on a project now, and it varies widely state to state. Over in Ohio, it's extremely difficult to get people to want to sign on, because I think solar companies went there early on and pulled some of these squirrely things that people didn't understand before. Well, you go to Kentucky to an area that they're grassland and raising cows on, and you offer them $800 to $1,000 an acre. They're welcoming you in, making you pie, and they don't want to let you leave until they got ink on the paper. So it is very interesting.
Yeah, and it's an immature market. It's going to, we come back and talk about this year from now, it's going to be interesting to see how it develops over the next 12 months. So it's going to change over time. I was going to shift gears and talk just a little bit about commodity outlook, and I won't spend too much time on this, but a couple of the key points, and this came up a little bit earlier. Exports, this is corn exports. USDA is currently forecasting 2.5 billion bushels. That's going to be really one of the keys to what happens with respect to corn prices going forward. These are the export numbers so far. I updated this yesterday, so this is through last week. And our total exports are down a little bit. Commitments to China are actually up a little bit on corn. That's not going to be true on the soybean side. And you know, you're all watching the weather forecast for South America, like everybody, and those are changing twice a day, sometimes 3 times a day, right? But one of the key points there is going to be what happens in South America is going to have an impact on our exports, right? So if you think about what's taking place with respect to South America weather, as their yields come down, if they come down further, or expected yields come down, that's probably just going to translate into stronger export volume for us. The other key point is what's going on with ethanol. And you can see how ethanol, corn used for ethanol production really took a dip in 19 and to some extent 20 as the pandemic was kind of hitting. And then we've seen some recovery, and USDA's got a forecast out for 2021 crop to be kind of a nice modest increase with respect to ethanol usage. And the question mark I have is, you know, how's that going to, only part of that slide came through, unfortunately. So this is, these are ethanol production numbers, and unfortunately the colors came through. That's the good news. The right-hand side is the most recent data. So that's weekly data, and the last 2 bars are the last couple of weeks. Those are the percent changes compared not to last year, but to 2 years ago. So every bar on that chart is compared to the pre-pandemic era. So in 2021, those red bars on the left are the big reductions we saw as people cut back on driving, right? The green bars are last fall, right? Ethanol numbers were basically skyrocketing, and we were as much as 8% above 2 years ago. Then it kind of started about Thanksgiving, started backing off a little bit. These last couple of weeks were pretty much even with where we were 2 years ago, which is kind of interesting. And the real question is, you know, where's Omicron going with respect to the virus, and what's that doing with respect to consumption numbers? My gut feel is it's probably not going to have that much impact. And we're probably going to see some pretty strong ethanol production numbers. And that's good for corn usage, right? That's positive if that really turns out to be the case. These are the margins. This is based on some data from Iowa State University where they simulate returns for a kind of a standard stylized ethanol production plant. And the returns last fall, when those ethanol production numbers were running above, way above 2 years ago, the returns to an ethanol plant were phenomenal, right? I mean, it was unbelievable. You translate that into a bushel of corn, how much they were making per bushel of corn, it was off the charts almost. Notice how that's come down though. It really has backed off quite a bit. I updated this yesterday as well. So that's through last week. We're down to about 23 cents a gallon. Good news is it's still positive. I suspect we're pretty close to the bottom there on the ethanol numbers. I think it's probably going to bottom out, and we're probably going to see some pretty strong consumption numbers. And my bias is USDA is probably too conservative. We'll probably see larger ethanol production usage of corn than what USDA is currently projecting. So if you take those two things together, if you think we're going to have some more hot, dry weather in South America, and you think ethanol production is going to be pretty good, that suggests the corn supply is going to be tighter than what USDA is suggesting. They're currently forecasting about a 10% carryover. 10% is always kind of the thumb rule I like to use. When carryover numbers are above 10% of usage, we're in pretty good shape in terms of supplies. You get below 10%, that's when you typically get more volatility in terms of prices. I think it's probably going to tighten relative to where it is today. And a lot of people in the trade expect that as well. So it's going to be interesting to see how that shakes out over the next 2 months. The bigger mover there is probably going to be South America. The smaller mover is probably going to be what takes place on the ethanol side. So these are the Brazilian corn production numbers, including USDA's most recent forecast. And usually when you see those are a million metric tons. I convert them to bushels, right? So that we can kind of maybe get a handle on it a little better. So to put it in perspective, you know, in round numbers, 15 billion bushels of corn in the US. Brazil's approaching, not quite, but they're approaching 1/3 the size of our corn industry. And that chart goes back to 2006. Notice how that's changed over time. They have become a much more important player in corn. We always talked about Brazil for soybeans. They have become a much more important player in the corn market than they used to be. So that's why what happens with respect to corn production in both Brazil and Argentina matters. both countries have become more important in terms of world corn supplies and world corn production than they used to be. And what takes place down there matters in the sense that if you pull those numbers back, those numbers are going to translate into US exports, right? They are basically not going to have much opportunity to increase anything other than, as they pull back their production numbers, what's going to take place is they're going to pull back on their exports and the US would pick up market share. These are the ending stocks, not for the entire world, which is not, usually that's what I use, but I think it's more informative to look at the major exporters. So just for grins, I guess, who are the major corn exporters? US, obviously. Brazil, Argentina, Ukraine, South Africa. Those are your 5 major exporters. Ukraine, very interesting, right? So Howard mentioned this earlier. What happens if Ukraine blows up? That's probably positive for corn prices, right? Because that pulls back on trade, both on wheat and corn. Taiwan, different story. I'm not going to delve into that one too much, but for Ukraine, that pulls back and probably is positive because it puts more emphasis on pulling corn from South America and the US, especially going to China, because China's been buying corn from Ukraine.
Jim, do you think the increase in corn production in South America is because they're having issues with beans after beans after beans after beans, or because their infrastructure is so much better now because China's invested $4 billion down there?
That's a good question, but I don't think I know the answer to it. And that's a really good question.
Care to speculate?
Yeah, I don't. Yeah, to me, it's all about second crop corn. That's what's really happened. It's more been a technology issue with respect to their ability to do the second crop corn.
Good.
But yeah, their infrastructure is better, but has it really kept up with the increase in production? That's probably not clear to me. They always seem to struggle on that side. But the key point is, if you look at it, well, I guess where I was going with this is, if you look at the world supplies from those major exporters, we're pretty tight, right? You lose very much corn to South America, things get tight in a hurry. And then it also puts a lot of pressure on us in 2022 to hit trendline yields, right? And we'll talk about acreage here in a minute. Oh, there's acreage, right? So there's the acreage issue, right? So we planted 93 million acres last year. Informa earlier this week came out with their early forecast. They're forecasting 91.5 million acres of corn in 2022. That's the big question mark. So I got to ask this group, those of you that plant corn, are you going to plant more or less corn than you did in 2021?
A bit less.
Less.
A little bit less. Never have a little bit less.
Okay. So typically, are you 50-50?
Yeah.
Okay. So are you going to be less than 50-50 on corn?
We're not doing, which isn't a lot, but still corn on corn, we're not doing.
And how about you?
That's the same.
So I did a meeting last week in Fort Wayne. It was kind of a discussion group of probably about 20 farmers there. And I did one at the Fort Wayne Farm Show. I guess I had some questions both of them. And most of the people there said they were sticking with 50-50. But the folks that said they were cutting back more than I anticipated. They said they were cutting back 25%. So the acreage, this is probably as much uncertainty as we've had on corn acreage in a long time.
Most of my high-risk river bottom farms, they're planning to go almost all beans this year.
Yeah, because they don't want to risk the input price.
Yeah,
input costs.
$1,500 anhydrous. They don't want to put it out there.
And lose it, right? Exactly.
Well, that worked out better for them on crop insurance too.
It'll save them some money on crop insurance.
Yeah. I would characterize Informa as being in the ballpark of what Michael Langemeyer and I have been thinking at Purdue. But when I talk to farmers, at least in Indiana, I wonder if that's too conservative. You know, when I'm hearing a little more heuristically about that. So I just put this in because if you didn't know it, we have a crop basis tool on our website, which is a handy way to check what's going on with basis. We update that on Friday. So this is when you go into the tool, you pick off your state. We cover Illinois, Indiana, Michigan, and Ohio, and then you pick off your county. And we don't actually report county level data, but we report, you pick off the county because we push you into the crop reporting district that you live in. And most people don't know what crop reporting district they're in, so we just have you pick the county. So this is for West Central, because Putnam is in West Central, although you guys are on the bubble between West Central, Central, and Southwest. I mean, you're kind of right on that edge. So you can look at all three of those. But I guess the key is we're running a little bit below the 3-year average, but not much. And I looked, for example, at Gavilon here up at Rochdale. I guess I looked at that this morning. This is maybe just slightly more negative than what Gavilon's showing. So it's pretty representative. But if you're not keeping up, this is a handy way to do it. We update it every Friday, so you kind of know what's going on. And it's interesting to look at other places in the state and see what's going on elsewhere, as Illinois and stuff like that. Shift gears real quick here and talk about soybeans. Soybean exports, USDA keeps pulling those numbers back because exports have been so weak. So this is the same chart I showed you for corn, but it looks different. Exports, total exports down 24% so far compared to last year. Exports to China about 27% below last year. On corn, we actually have corn exports to China up slightly compared to last year. So big shift there. And then the total exports and corn were down about, I think maybe 5%, whereas we're down about 24 here. So USDA has been pulling those numbers back. Again, this is going to be so heavily dependent on what happens in South America, right? That's going to be the big driver. Soybean ending stocks, 8% of usage. So we're below that 10% I mentioned earlier. But the negative on soybeans has been, what was that number forecast for the 21 crop back in July and August? At one point, we thought it'd be less than 4%, right? So as we went through the fall, the yield numbers kept coming up and we kept pulling back on exports. We kept saying, well, we're gonna have more carryover than we thought. So we're at 8% at the moment. But I think that could shrink, particularly if we see any more weather problems in South America. It's still a little early to forecast yields down there. But we're going to get those weather reports every single day, actually twice a day. So here's the Brazilian soybean numbers. Go back to 2006, they were at 2 billion bushels. Now they're at 5 billion bushels. I mean, they just become a bigger and bigger player. They produce more soybeans than we do, right? I have a longer term chart of this, and it goes back to the 70s. You know, in the 70s, USDA didn't start reporting Brazilian numbers until I think 1977, because prior to that, they were so small, they really weren't that relevant. So it's been a dramatic change, but they just keep getting bigger and bigger. Argentina, different, pretty much flatline, right? Not much growth in the Argentine industry. Largely, as best I can tell, because they have so many problems with what they do with respect to taxation, et cetera, down there. They just continually discourage people from doing things that make a lot of sense. So these are the ending stocks for the major exporters. Who are the major soybean exporters? This is easier than corn. Us, Brazil, Argentina, and that's it for the whole world, right? That's it. Virtually almost all the soybeans in the world are produced in those three countries. There's a little bit, Paraguay's the other one that's in there, but Paraguay's very small. So you can see the same trend, not quite as tight as what we saw with respect to corn. But again, a lot of pressure to keep the numbers going, right? If you tighten things up either in South America or in the US this year, pretty positive for prices. The wild card for soybeans is what happens to acreage. Informa's acreage for estimate was only up 600,000 acres, which strikes me as small. That's going to be very interesting to see what happens. I think a lot of people are worried. Early on, there were some forecasts suggesting we would actually pull 3 million acres out of corn and dump them right into soybeans, which would put us both at 90 million acres, basically. That's a different scenario than what they're projecting. And I think we're probably going to debate that all the way up until planting season in terms of what these acreage numbers really turn out to be. I did a meeting, been a couple of weeks ago, and this was a kind of a seed company source, and it was focused a little more on Kentucky and extreme southern Indiana. And what they were picking up based on seed sales was a bigger shift to soybeans than what, for example, what Inform was picking up. Maybe consistent with what you were talking about, right? Some of the more marginal acres. I think it's going to be a serious debate. My guess is we'll see more soybean acres than what Inform has got out there. I think there's going to be more switching going on than that. There's the basis chart for West Central Indiana. Check that out. Howard mentioned this earlier. This is cash rents. So this is based on some work by my colleague, Michael Langemeier. Let me tell you how this is put together. So this is based on the simulated return for a West Central Indiana farm. And he simulated those returns going back to 2007. So he does all the financials for it and works his way through. So if you look at the right-hand side of that slide, and those numbers are a little hard to read, for 2020, the net return to land was 328. The estimated net return to land for 21 was roughly $100 higher than that, so 422. So he did some modeling work a few years ago with one of his graduate students to try and estimate, well, how does cash rent change as returns to land change over time, right? How much of that gets bid into cash rent? So if you take that difference between the 328 and 422 and round it off to $100, what those models suggest is about 10% of that difference, that $100, will be reflected in the next year's cash rent. So if you look at that $100, that probably means the average cash rent in West Central Indiana would go up about $10 an acre. Okay. Think about that in terms of percentages, maybe 5%. Given what's going on this winter and given what's going on with farmland prices, that's probably a little bit on the conservative side, but unequivocally, it looks like we're going to see average cash rents increase in 2022 versus 2021. These are the estimated income numbers off of that 3,000 acre corn and soybean farm in West Central Indiana. 21, fantastic year. 22, with the rise in cost, maybe not so good, right? Not a terrible year. I mean, 22, that projection suggesting maybe in the ballpark of what 20 was, right? Kind of a return to that level. That's going to fluctuate as prices go up and down, but it does include the high cost that we're looking at in terms of returns. For those of you that are thinking about planting corn, what are you doing with your nitrogen rates? Have you looked at that? Same. Okay, so on the current survey, which we're going to release next week, we asked that question. So people that are planting corn, what are you going to do? 60% of the people in the survey said they're going to hold the nitrogen rates constant with what they did last year. 40% said they're going to reduce nitrogen rates. So this is based, and if you haven't done this, I would encourage you to look at the corn nitrogen rate calculator at Iowa State. Yeah.
You know, I think a lot of that too is, and I don't know how you incorporate it into a question, but I mean, obviously nitrogen, some was prepaid. I mean, don't get me wrong, high prices, but a lot less than what it is today versus if a guy hasn't locked in any nitrogen today. I mean, it's obviously a totally different story.
Exactly.
So obviously that would affect what a guy's going to potentially plan on.
And people that put it on last fall probably did what they normally do, or maybe even a little better. So yeah, that's a good point. If you haven't looked at the corn nitrogen rate calculator, it's a website at Iowa State. It includes data from Purdue, Illinois, Iowa State. I think Minnesota's in there, might be one other state. But what they've done, and then when you go to the website, you pick off your state. It's kind of like our basis tool. You say, well, I'm in Indiana. And then it asks you, well, where are you at in Indiana? So it's regionalized. And so at that point, you're now using data that came from Purdue. And so you're using the nitrogen rate response curves that Bob Nielsen and Jim Cambrato have estimated for the last 15 years. So that's where the data on this slide came from. So at 40 cents per pound of nitrogen and $5.30 corn, which is pretty close to where futures are today with basis incorporated. I'll show that in a minute, but I think that's pretty close. 40 cents a pound, that's probably about what a lot of people were paying last year, right? Pretty close. Your optimal end rate, this was for Northwest and North Central Indiana. I didn't redo it for this part of the state, but wouldn't change too much. The optimal end rate worked out to 193 pounds of nitrogen, okay? And you can pick off, when you go to the tool, it's up to you to put in what corn price you want to look at, right? And what nitrogen price you want to look at, okay? So you can look at different scenarios. So then slide all the way down to $1, which is pretty close to where anhydrous ammonia is based on USDA's price report for last week. They just came out with their new report, I guess, yesterday, which is last week's data. And it's just under $1. It's not quite $1 for anhydrous. So an optimal end rate at $5.30 does drop 30 pounds. Okay. The interesting thing to me is what happens to yield. That yield column, third column. If you haven't really looked at those nitrogen response curves, it's worth just going to the tool and looking at it. You can reduce nitrogen rate and not have very much impact on yield. And the reason is those nitrogen response curves are pretty flat at the top. So they go like this, and then they kind of level off. So there's actually a band of nitrogen rates that'll give you an optimal, or pretty close to optimal yield. And so what the tool is suggesting is you can back off and really not give much up in the way of yield, okay? So I would, if you haven't done it, I would encourage you to do it. You can just look at all the different scenarios and then think about what you want to do this spring with respect to either your pre-plan or maybe if you're side dressing. But it's very interesting. And the interesting thing, and I've done some meetings with Bob Nielsen over the years. He and I had a debate one day, I guess at a meeting we did down in Southwest Indiana, because he put the curve up and I said, as an economist, I want to be at the left-hand point, right where that curve levels off. And Bob, of course, as an agronomist, wanted to be farther right because he wanted to make sure he had enough nitrogen on, right? So you get that debate, and that's really what you can play games with when you look at the tools. You can kind of look at that trade-off and figure out, you know, how close to the edge do I want to be? And of course, there's always some uncertainty about nitrogen response because of weather. You know, you put it on today and then you get a 6-inch rain tomorrow, you know, what happens in that scenario. So there's always that level of uncertainty. But I would encourage you to take a look at it. For the folks that aren't thinking about cutting rates at all, I mean, think about reducing them a little bit depending on your scenario. Just a little bit on the break-even prices. Again, this is some data from Michael Langemeyer. He's done that for that simulated farm. As you look at break-even prices on the lower productivity soils, and you cover total cost, which includes the opportunity cost on everything, right? You're getting up close to $6 a bushel. If you're looking at just variable costs, you're getting close to $4 a bushel. And on the high productivity soils, you know, you're looking at variable costs in the ballpark of about $3 a bushel. So it is a high cost environment. Similar story on soybeans, variable costs quite a bit lower. And that's, of course, is what's encouraging people to think about more beans and maybe a little less corn, right? So, and this chart keeps changing. So we highlighted, this is from a couple of weeks ago, we highlighted kind of looking at, do I want to plant second-year soybeans or do I just want to rotate, keep my 50-50 going, right? So the way you interpret this chart, and this is from one of our webinars, you pick a soybean price on the left-hand side, and I highlighted 12.50. If I was going to do it this morning, I would have highlighted 13. And then you say, okay, which productivity category am I in? Am I in the high productivity or the average? What corn price would I need to compete with 12.50 soybeans? So at 12.50, if you're at average productivity soils, 554 would give you the same net return at current cost of production, okay? You think you can get more than that for corn? You'd be better off planting corn. If your corn price is less than that, you're obviously going to be better off planting the second-year soybeans. At 13, it starts to shift a little more towards favoring soybeans, which is kind of where we're at today, particularly if you're looking at the average productivity at 569, because that is higher than what fall crop bids are. Okay.
Are you guys going to keep your same rotations, or are you going to wait it for this year? Sorry,
that's a mystery. It's a mystery, Howard. We're never going to tell you.
I deserve what I get.
What we concluded is, as I've done meetings around Indiana, more people are thinking about switching at least a portion of what normally would go to corn than.
And I asked because of the Brock seminar. Brock does the seminars in December. And he asked his crowd, now granted, this is no science. It was just raise your hand if you're going to keep your same rotation. And the majority of the folks, and Nolan, you were at that meeting, but I think the majority of the folks raised their hand and said they were going to keep with kind of the same rotation they had.
Well, I think that's true. And I think at the end of the day, it will be a majority. But it doesn't take very many people to cut back 20 or 30% to start impacting those acreage figures, right? Because that's the bubble, so to speak. And as I've done meetings around Indiana, again, this isn't very scientific because it's rooms like this, or maybe twice this number, or something like that. But I've got more hands saying I'm going to reduce my corn acreage by 20 or 30% than I would have guessed. And the caveat to that is soybeans historically are more competitive in the Eastern Corn Belt with corn than they are in the Western Corn Belt. So truthfully, I would expect to see more switching in Ohio, especially Eastern Indiana. Our budget suggests there's even a difference as you kind of go through the middle of the state. Eastern Indiana, soybeans a little more competitive than Western. Does that match up with what you guys see in some of your budgets? So we're probably in that part of the world where switching is probably going to be a little more competitive than, for example, Iowa. Iowa historically stronger on corn. So yeah, I told you I updated these this morning. These are based on the overnight prices. So if you look at West Central Indiana, soybeans for May delivery, basis forecast coming off our basis tool, 1445. Harvest delivery, about 1316. So pretty close to that $13 mark I was using on that previous slide. And then on the corn side, yeah, we were at 554 for fall. Okay, a little closer than I remember. Of course, those are going to change every 20 minutes, I suppose, but interesting. All right, so with that, I conclude. I probably talked too long. We do webinars once a month. Michael Langenmeyer and Nathan Thompson and I do a webinar every month to kind of update the outlook information. We do it following USDA's release of their World Ag Supply Demand estimates. So we give a nice overview of what they've done and then a little bit of our interpretation of what we think is going to happen. If you sign up for those, you get an email from us with a link. You can watch them live. More people watch them on the video than they do live. So if you like to do it at your own convenience, you can watch them on our YouTube channel and you get the link. And then we release them also as a podcast. And recently, I think more people are picking up on the podcast because you can do that when you're driving and whatever you want to do, right? So with that, all right, cool. Questions? Cool. Steve, you're up.
Thank you.
Steve, you want to do your own introductions or how do you want?
Yeah, I'm Steve. Yeah, I mean, that's up to you, Howard. What are you going to do?
No, go ahead. You know your team and how are you going to do it?
So I got good news. I'm slotted for 45 minutes, and I guarantee you it won't be 45 minutes.
It'll be an hour 45.
No, it won't. It won't be that at all. So, because I don't think I need to take file break. The only risk I ask you to come back if you don't. But I'm Steve Widgets. I'm the Senior Vice President of Lending here in the state of Indiana. And I'm originally an Illinois boy, and we talked about Illinois a little bit a while ago. And I love being over here in Indiana. I'm only here at Hoosier during the week, and I go back and see my wife and grandkids on the weekends. So wouldn't be for kids and grandkids. I think we'd relocate to Indiana completely. So, but I joined the team over here in March of 19. So I'm coming up on my 3rd year anniversary here with Farm Credit Mid-America. We have Lisa Chad and Stephanie Greenlee. Stephanie's from Crawfordsville, and Lisa's local here. And I get to work, the pleasure of working with these wonderful ladies. But I think you all probably know Farm Credit. We are up to a $32 billion cooperative. Our growth in loan demand has just been phenomenal. Combination of things. Interest rates obviously have been very favorable, and labor market. We all know what that's doing. So a lot more opportunities from that standpoint. I just wanted to start out with this. You know, I was talking a little bit earlier. Volatility is alive and well, and I wonder in our industry if it's here to stay, and I think it probably is. When you think about, oh, by the way, I'm gonna take time out. The sale, 15,000. The Wabi was 162. Came out in 92 on the Wabi. So I have. What's that?
That would be a lot.
I was gonna say it's pretty good sale. Isn't it? Yeah. So I just got a text too. Over on the west side of Illinois, just this side of St. Louis, ground that would be comparable to the better ground here in Putnam County. There was an auction yesterday, around 18 grand. So to give you an idea, I mean, that's not the black stuff of Central Illinois, folks. It does have some urban influence, but it's farm ground. It doesn't, it's not development ground. So it's just this land market is crazy.
How big a parcel?
It was only 30 acres, okay. But everything over there brings, it does have that metro influence, but there's a lot of livestock there, which you could say, you know, there's a lot of confinement livestock, so people really bet up.
So an 80 or a 200 would probably bring about the same.
Yeah, it would.
Okay.
Yeah, I remember the day when I started. I got to tell you this too. We were talking about earlier, talking about the times where the way things have changed. I remember I started in 85. Okay, throes of
Farm Credit in 85.
Yes.
Wow.
I'm over. So I got 36. I went to a bank for a year, and so but I got 36 years in next month. I remember looking at tax returns where the interest expense was greater than the gross revenue.
Yeah.
You know, and it's just amazing what we saw. That I took an office over in Fayette County, Indiana, or Illinois, not Fayette County, Indiana, small town Vandalia. I remember when I got there, my credit quality was 26%. I had 26% acceptable profit. I mean, everything. I had delinquent drawers stacked up alphabetically. I mean, that's what I did in my early going. But you know, and I think back, and I'm going to talk a little bit here about the balance sheet. The balance sheet, I think, is one of the most important documents that you have on your farm. I'm a big proponent of the balance sheet. I encourage everyone to do a very thorough year-end balance sheet. I think it's the most important action you can take when it comes to financial management. Sometimes I say, you know, guys used to trade combines every year. I compare it to that. Well, if you trade that combine in, trade your balance sheet in for everyone. And because the trend in a balance sheet is critical. And it's just something I've learned over the year. And I practice what I preach. I do it myself. And by the way, I have 100 acres in Southern Illinois, 100% soybeans this year. So that's going to be a big supply on the soybeans.
Market mover.
Yeah. We had 200 bushel of corn down there last year, which is just unheard of for deep Southern Illinois. I mean, it's similar to probably Brown County, Indiana, and you know, down west. But anyway, volatility is here. And you know, my upbringing, I will tell you just one thing. I think it's important. I'm a very conservative individual, and I've butted heads with farmers over the years when I've been working with them, because I tend to give them a conservative approach to what they're doing, and they always challenge me with more risk and so on and so forth. But when my dad was 50 years old, we put him in, I mean, we had to treat him for depression. And I saw that in a very young part of my age, and Dad had no debt on the farm. And I couldn't understand at that time why Dad, we literally had to shock him to get him out of depression. And somebody told me, and I never thought about this, they said, when you think about it, your dad being debt-free has everything to lose. You know, and I think it's just, you know, your upbringing and what have you really molds you into what you are. So I am a conservative person. The reason I'm saying this, we're talking about volatility here, and it's football season, and Bear Bryant was a great coach down in Alabama. He said offense sells tickets, but defense wins championships. And when I think about that, the reason I give you the background on my nature and what have you, I've always been wanting, having conversations with farmers, to have a defensive strategy to protect the balance sheet. Now, folks, that doesn't mean that I think you should go out and buy land today, or those type of things. I think everything needs to be a strategic decision. But I share this with you because here's why I got a football finance analogy here. First, I'm going to start out with, in football, you got a defensive line, right? You got the front guys in the front here. That's your defensive line. So think about this as I do this, we're protecting the balance sheet, okay? In football, you're protecting the other team from scoring. So in your second, you got your linebackers, right? If the defense gets through there, they got their linebackers, right? Okay, if they fail, you got your secondary to prevent that touchdown. In other words, put you behind, right? So let's talk about this, earnings. I consider earnings our defensive line. So when you think about that, if you've got strong earnings, you're going to grow your balance sheet. You're probably going to grow your working capital, depending on how you might finance assets and those type of things. If your earnings are weak, your linebackers are your working capital. Okay? So think about it from that standpoint. So if our earnings are weak, what do? What's your risk mitigant? And it's working capital, right? Now, if working capital fails, what's left is our secondary and our net worth. And that's when you start chewing in equity, which is obviously something I've seen a lot of early on in my career, okay? You know, Howard talked a little bit about his charts and looking through there at 15, 16, we saw working capital dip. And so when I think about this, comparing 15, 17 type era to 21, what was our earnings were pretty weak. Revenues were down, right? Consequently, 21, I'm contrasting these, profits extremely good in 21. I know that because on my few little 100 acres down south, I can't believe the net that I had off that 100 acres down there. Then when I think about real farmers, like some of you, like, you know, we've had a tremendous year, right? Working capital. going down, right? Where are we at today? Probably not across the board, but cash is piled up pretty nice. Our solvency back at that time, more than adequate. I mean, balance sheets were strong back in 15. They're even stronger now for very reasons that Howard shared and looking at what these land values are doing and what have you. So my point to all of this is, what I want you to take from that is, you know, when earnings are going well, obviously it's really easy, right? Dr. Cole, which a lot of you are probably heard speak before, and I've never forgotten this. He says, what you do during a good time that prepares you for the bad times. You know, and I think as I look here, when I look at where we were just 18 months ago, we were talking earlier, 18 months ago, where were we? I mean, I remember literally our strategy from my position down with my team, we had certain accounts. Our target was to get together with them and talk about, are they going to have enough cash flow to meet payments? That was our strategy in the summer of 20. That fall, we changed that to, hey, let's get together with these same individuals. Let's talk about preserving working capital because the numbers all changed. And so the volatility makes this a much more slippery game from that standpoint. So my takeaway from this is just really think about that defensive strategy you have. You know, as a lender, when we look at this, if your earnings, I mean, that's part of our analysis every year, is looking at that balance sheet. You know, if your balance sheet net worth grows, let's say $100,000, but you got $150,000 in payments, you made money, you just didn't make enough money. And you're going to lose working capital. So one of my biggest recommendations does everybody do your balance sheets in there? Do you do them year in? And coordinate and look at that. Okay, that's awesome. So you guys don't need any of my strategies. So you're that one down. But just look how volatile that's been just in the last 4 years. And even close to look where we were 18 months ago. And so I think right now is really exciting. It's, you know, it's fun when we look at talk about delinquent payments. I don't want to mention to Howard or Jim. Yeah, I mean, ours is almost, I mean, we got a little bit in our $33 billion portfolio, but it's minuscule. I'm not going to go through a lot of these here because Jim and Howard have already kind of hit on. The one thing I'll talk about here, and I look at average productivity, and I think this is Purdue numbers on corner. I think it says 225 bucks. I think we got to watch for, and this is the thing that I think will have the impact on the land values is the Fed and what interest rates do. I mean, interest rates are already going up. Our cost of money has gone up almost 75 to 90 basis points from a year ago. So we move at the market every day. We get new rates every day. So as the market is moving, we watch the 10-year treasury because that's where we compete with. I think it's up 40 basis points since mid-December. So, you know, the inflation fears and all those type of things are already at work. I don't know that anybody knows what the Fed's going to do. I mean, you know, they passed this week. They didn't do anything, which was expected. Now they're expecting in March, but are they going to do a quarter? They're going to do a half. You know, if we have 3 half-point rate hikes, that's going to start hurting a little bit. And my point on this is I caution guys as we look here now, if you've locked inputs already and the prices we got now, actually our profits for 22 look pretty darn strong. Our potential, assuming we raise the crop. We have average yields and we got these kind of input prices and you're subject to higher interest rates, those margins are going to get tight pretty quickly. So all of that, when you think about how well pieces going together, the earnings and the impact earnings or lack thereof has on the working capital, the last thing you want to do is dip down into your secondary, right? And we're in there, we hardly have nobody that we're really concerned about at this point in time. There's always a few, but we're in good shape as in now. So this is why I say I don't want to come across negative, but I've always got a defensive strategy in mind when I talk about the balance sheet. When I'm talking, I don't get to talk farmers that much anymore because they got me away from all that. But in my day when I did, I enjoyed that part. I'm going to go through. I got some survey data that I'm going to get to here in a little bit. Howard's kind of already talked about this. You know, this goes out to 27. Now this is the Fed fund rate, so you gotta add 3% to that. So, I mean, if we get up into this range, today we're at a quarter point. So if we get to 1.25, we're still at 4.25 on operating, which obviously isn't as nice as it is today, but it's not bad. So inflation, we know about that. This is interesting here. The red line is CPI versus the 10-year Treasury line. Look at that gap. I think it's kind of funny when even like a couple of years ago, they were talking about inflation really wasn't that big a deal. Tell that to agriculture. Tell that to buying machinery. I mean, we've been fighting inflation in a lot of things for quite some time. Like I say, Howard's kind of hit on some of this already. We obviously didn't coordinate on slides, and that's fine, from that standpoint. This is just a different graph. It's interesting. Look at this is the real estate debt, and Howard had a little different graph up. But look at the real estate debt's done since 14. And it's interesting. Your non-interest or non-real estate debt has been pretty steady. And this chart kind of surprised me a little bit because I thought really right in here when we saw the working capital dips and what have you, I would have thought this would have been maybe a little bit of a bump. But non-real estate debt is very steady. And when you think about real estate debt going up, that makes sense. Yes, Steve.
Steve, so those are the U.S. numbers from just here, right?
Yeah.
How does that compare to what you guys see at Farm Credit? Is that pretty consistent with what your own experiences?
Oh yeah, definitely. Yeah. That's why I say what we saw here in that 15, 17 range. Well, even more recent. I got here in 19, but when I was in Illinois, we started seeing these current liquidity was really getting tight, right? So this surprises me here. I think, at least what we've seen here in Midwest agriculture, I think we would have seen a bump in here. My opinion.
Well, so out of your 32 billion, how much is real estate debt versus how much is non?
Our portfolio is about 70% mortgage. Operating is around 20, and then the other 10% is equipment.
And you went back 7 years, is that the same ratio?
Pretty much.
That's what this is.
Yeah, pretty much. I mean, we've always been heavy on the mortgage side. That's the one chart that Howard had. I think he had this one up there as well. When we look at this, everybody remembers that boom. 2012. That was interesting. 2012. 21 might top it, I guess. But 2012 was the most profitable year I've ever seen in my career. It's the only thing I think the government ever did well was market up corn at $7.15 a bushel. And we got that on our claims. And it's just incredible when we look at. I think we're in a good spot today, but look where it is today. Now this is the entire farm sector. So it's got every aspect of agriculture in it. Obviously we're pretty up like grain here. Howard, I think you had this one up earlier as well. That gross working capital revenues. The other thing that I thought you had up there earlier, which is very, very relevant, was that your income to debt, and it hit 5.5. I think in 19 it hit 5.5.
I found that chart out of I think Pro Farmers Land publication years ago. And the thing that they pointed out was that started to go above the 5.5, 76.77. So that they call it their early warning signal, that one ratio.
And Dr. Cole will tell you it hits at 6. You better start having some lights going off and really looking at what you're doing. That's his guidance.
Yep.
So we were getting there, and we were feeling our portfolio too. I mean, our adverse. I'd say 3 years ago, our adverse portfolio was twice what it is today. Now it wasn't awful. It's just really good today.
We had some really tough years leading up to that.
Yeah. And honestly, I really thought once we got out of this period and came down into here, I mean, we saw what I call a healthy correction land. 15, 20%, where you want to call it. I actually thought it might be a little bit more severe, but again, I'm conservative. So, I think the thing we have to keep in mind is what happened the last 18 months and what could happen the next 18 months again that might go a little bit. Something that's not been brought up today is African swine flu, which is is it Puerto Rico, Dominican Republic, Haiti? It's in our backyard now. But that, start getting a bunch of hogs, that'll take care of some foreign usage. You know, so there's another thing that's a variable in this right now. So, like I say, you probably figured out I'm a big proponent of the year-end balance sheet. And I applaud you for doing that. My wife thinks I'm a geek, and that's okay. I look at that every year, even myself, and I've just seen how much value that it is for you to understand, even in a tough year, if you lost money, it's good to know what that actual number was. I think the biggest unknown expense a lot of farmers deal with is living. Some of them don't want to know, but if you're doing a good year-end balance sheet, that takes into account your living. You know, and I can tell a story. I'll share this one with you real quick. His name was Daryl, and he was before his time. Daryl passed away about 10 years ago, and I used to work with him, and he was just phenomenal when it came to records. So phenomenal. I mean, he did, you know, tax returns a piece of crap. Okay, so you know, the only reason we do that is because government makes us. You know, it's. I tell my team, all I care about is the balance sheet. I know we're going to get the tax return, but I don't care when we get it because it just doesn't tell us anything. But this guy, Daryl, did a really, really good job. He consistently did year-end balance sheets. He did accrual income statements. He reconciled the accrual income statement to his change in net worth. It was just, I mean, he just did a phenomenal job. I sat down with him to do his renewal one year, and right off the bat, he said, "Steve, I got a big issue this year." And, you know, I'm like, "Well, Daryl, what's the problem?" He said, "My net income and my balance sheet reconciliation is off by 3 cents. So me being fairly witty, I had my note folder open, and I just closed the dang thing up. I said, "Daryl, if you can't get close to that, there's no way in hell." We have a Know to Grow conference Tuesday next week. I want to tell that story to the young farmers that come to our Know to Grow. And the importance of that is the confidence I had in Daryl in his financing made it really easy for us to work together and lend me money. And you want your lender to be confident in you, and we want to be confident in you. And if we could do that, I never told Daryl no. I mean, Daryl never came to us with anything that would make no, because he knew. All right. Now, I tell everybody, just because you do those doesn't mean we say yes forever, but the power of quality financials, I think it needs to be talked about more because it's real. Because the confidence in the relationship is critical. Break-even analysis, who does that? So, yeah, not fun. Cash flow. Cash flows, yeah. I mean, I had a guy tell me one year, he said, "What's the point in doing that? I don't know what my yields are." And I started to argue with him, and then I figured out this stupid, don't argue with him. It's a dumb idea, forget it. But there's tools out there that can allow you to do some what if scenarios, and I highly recommend them. Here, I like this one: minimize marketing emotions. Easy said, right? I sold some new crop beans the other day. I think I got $12.95 because I thought good place to start. Now they're $13.30. Thank God I haven't quit my farm credit job and live on 100 acres. So, but this is a big deal here, and I think when we do a really, really good job of keeping our financials and understanding our profitability historically, you know what the trends are and those type of things, I think we can make better decisions if we're doing all of this. You know, the old saying is you never go broke making a profit. All right, you can lose working capital if you're not making enough profit, but profit is a profit. And then if you haven't done this, I mean, there's still time to lock in fixed rate. I wish we was at 4% today, Howard, we're not. But I know that was October. Yeah, and so, but we're still, I mean, especially when you take into account our patronage in those programs, there's still, if you've got, I would just advise you to really check in if you don't have longer term debt fixed. Now is probably a good time to do it, especially with us because we've got really awesome conversion options. My officers every year, and if I lied already, I'm going too long. our officers every year, I mean, I always tell them, I said, interest rate's important, but you need to bring value. And people pay for value. So if they're beating you up on rate, you're not bringing enough value. They don't like when I say that. But I told them the other day, I said, the good thing about rates going up is once rates go up and they go back down, we can call customers and convert their rates, and then you make them happy again. So it's all a matter of looking at the glass half empty or half empty. I'm going to skip through this, not this. So what we did, and I'll wrap up here. I got a few slides I'll just share with you. We partnered with Farm Bureau, Indiana Farm Bureau, last year to survey Indiana farmers on the upcoming farm bill, what's important to them, and what have you. And we had a session with them here not too long ago, and they gave us the outcome of that. So this is, I don't know, maybe some of you got the survey, but this is your state of Indiana here, talking about the farm bill. And this is just, where do you get your news on farm bill? It's not a big deal. It's kind of interesting. Most of it's from the internet. That's not a surprise. Farm Bureau was second, then on down. This is about producer engagement, just talking about, are you willing to get involved in those type of things. Here, am I willing to support those lobbying? 60% said yes. Am I willing to get personally involved talking to legislators? 35%, which I thought was kind of strong. I thought most people tried to avoid that for the most part. I will not pay attention to the debate at all. There's 5% of the people in this country that don't, or in this state that don't get a damn. So, but anyway, some of these other ones here, how about farmer sentiment toward the state of the country? So this is, Jim, I would say this would go into your Ag Barometer from a farmer perspective. But, you can look across there, 3% satisfied, 39% not very, and 25%, I mean, completely. So here's most producers where they feel that the country's going in the wrong track. The biggest concern is increased government regulation. This one was interesting, loss of the family farm. And I think, we were talking about that, we think that is a tax issue. For fear of taxes and those type of things, it passes the family farm on. Yeah, it loses a lot of those things. I think that's what that was. This is, I think, relevant. Lack of consumer understanding about farming practices. We all know that. That's one area where we all can have an impact. Consolidation to the agribusiness industry. I think that's alive and well. Here's a shock. Now, this isn't a shocker. Regulatory policies are viewed by most as heading in the wrong direction. Our primary concerns, farmers in Indiana are the #1 input cost, and this is where I think the loss of the family farm comes into play. Taxes is second at 44%. Commodity market volatility. We just talked about that. I mean, that's, the good thing about that is that's one thing you do have control over. I mean, it really is from a market standpoint. Now you have to be content with your decisions once you make them. I know, easier said than done. Pesticide, water are the most burden. So federal regulatory actions to the farmer. What are big concerns? Pesticides, water quality, transportation. Again, probably not shocking. We're under the gun a lot anymore with rural influence, etc. Or urban influence, I mean. Here's the most used government programs: NRCS, EQIP, CSP, and they get. So, average producer in Indiana is using 1.7 programs. That's probably not a surprise. They were all using to some degree. Crop insurance and trade are the top two most important to the Farm Bill. And we don't, 6% of the people think we need to eliminate it. That's interesting. Here's a biggie. What's rural broadband like in your areas? Is it getting better? I know I hear some areas it's good, in some areas it's something close to pathetic. Broadband continues to be rural water. So here, this what they're saying is the feedback is that there needs to be payment adjustments for inflation. on crop insurance. I think it's going to be a hard sell. It's subsidized pretty heavy already. From that standpoint. Obviously, from a producer standpoint, or livestock producers, the sustainable best production practices is really critical. And I told you I'd do less than 45 minutes, so that's my last slide. So obviously, the dirt's a little too wet to do this right now, but hopefully 2022 will be good to you. I know if you've locked in those input prices, which I know a lot of entities, that's a big deal, obviously, you know, as we look at going into 2022. But I don't know if anybody's got any questions about all that I just spewed out there.
About but when every year in the last 10, we had a chance to sell that profit, and you have,
yeah,
and it's not been one day.
Right.
It's been
and that's what I mean. The market usually give it,
yeah,
and the market usually take it away.
but to your point about knowing your break even,
Big deal.
if you know that, and then you're at a time like today where you can lock in profitable prices, and okay, $12.95 was stupid. Why didn't you get the $13.30? Except $12.95 was profitable.
Absolutely.
And you just sell another.
Right. And that's a good point. We can't control the markets, but we can make decisions on what the market gives us. You know, and I know people that got burnt in 12. And I just love, my brother's good at this. He's 50 years old. And one thing happened. It'd be 20 years ago. And we never forget. Yeah, I remember back in 1999, we did that and everybody was a damn, you know, and that's the emotion piece that just comes into it. We're fearful to make mistakes. One of the questions I just ask you, do you have 10,000 bushels of beans? What's that?
Easy.
Oh, it's really easy. Yeah, yeah. So you got 10,000 bushels of corn, beans to sell. Yeah, let's say from last year. Okay, you sell half of them today. I don't care. Take the price. 14. Go for 15. So you sold that 5,000 bushels for $15 today. Big blow up in the market. Beans are up 50 cents overnight. What's your emotions?
Well, so first, that's a really good question, comment, because I mean, so I help farm, family farm, we farm. I sell some seeds. I work with growers, so we have these conversations.
This is the longest answer I've ever had.
Sorry.
No, I'm just
it might explain my answer.
No, I'm kidding. Go ahead.
You talked about being kind of conservative in personality, you know.
Yes.
And my personality, I don't get too worked up about that.
Okay.
I don't know why. I mean,
that's good for you.
Because my goodness, you know, that's a tremendous price I just sold beans at. You know,
if you just one more day, you got 50 cents.
Now I struggle with that. I struggle with other areas where I get too worked up about stuff, but I will talk to, you know, friends, growers,
yeah,
you know, and it is it's a frustration. It's a you know, you feel like, hey, I made a mistake, whether you're affecting your family or whoever. But maybe I wasn't the right one to ask.
No, you aren't. That was a terrible answer. No, I appreciate it. No, I'm glad you did answer that way. But, you know, a lot of times I get 50-50 on that because we want to feel good about the sale we made yesterday. Right?
Yeah.
I mean, I think if we want to be honest with, that's part of that emotion. In fact, I know it is because I hear it too often. We still got 5,000 bushels to sell, right?
Yeah.
Yeah. You know, so that's my example of emotions. You know, and it's, I've seen it, you know, and I used to always get this question, should I sell grain? And I'm like, oh God, don't ask me that stupid question. I'm not going to text it. I'm just kidding. But my response to that always was, I would never be critical of that kind of sale. That was my answer, because I can't tell you when to sell grain for limited liability and those type of things. But my way of handling customers over the years was, you know, you're locked in a profit. And that was my assurance to him. I would say, I wouldn't criticize you ever for that sale. That was my canned answer a lot of times. So, but man, the people that struggle over it is big time in the margin calls. I've seen people freak out on that. You know, we got the calls and puts and all those type of things. Obviously, that you have the right perspective on a call and put. I mean, by a call, don't plan on making money. You know, if it happens to work out for you, great. But you know, from a lending perspective, I think the industry obviously is in great shape. I mean, we're our portfolio, like I say, working with our customers are as good as we could really expect right now. So it's going to be interesting on the supply chain. And, you know, I've been around a little bit talking to the larger farmers where a lot of guys fortunately got a lot of their stuff on and locked in, which is awesome. Because $1,400, $1,500 anhydrous is not going to be fun from that standpoint. Be a good tax write-off for a guy like me. But I'm going all beans, man. I'm flooding the market. So I might just go ahead and prepay some anhydrous for 2023 now. And
You want to lock in the tax write-off.
Now,
you know, Farm Credit, they want to rethink how they do.
Well, we're pushing our employees to be innovative. I think that's innovative. It's the tax credit. So, but anyway, Howard, and great to be a part of these sessions. And thank you all that have shown up here today. And we're just here. I mean, our purpose is to secure the future of rural communities in agriculture. And I preach this to my team, and I hope Stephanie and Lisa could repeat this, but you know, we always want to be out doing what we can to help the customers and do the right thing, you know, and I always say the right thing isn't always a yes. I mean, it might be something that we challenge from time to time, but we are grounded in what's good for you is good for us.
Steve, we were talking Tuesday night because we did a seminar with Milwaukee.
Yeah.
And the lenders, the ag lenders, because you obviously started at 5.
Yes.
And the perspective you bring from the 1980s. What's your loan limit today at Farm Credit on an acre of land?
Well, that's an interesting one. I mean, we loan. I mean, we kind of have a you know a matrix where we'll go up to like a rule of 90, 95. So 20-year note, 70%. You know, that was kind of a mix. But right now we're capped at $7 grand.
So that's my point. Is that there's a governor in place.
Yeah.
And I'm not so sure some of the lending in the late 1970s had that kind of perspective.
Oh, absolutely not.
And I know I sit on a bank board at Aggiecon Bank, and their limit's 4,500.
Yeah.
They're not competitive with Farm Credit. That's fine. But the point is that limit has a lot of protection. The other thing is what I think Natasha said, 75% of your farm real estate loans are fixed.
Yes.
So you think interest rates shoot up 300 basis points? Well, that's a concern, except that a lot of these rates are already fixed.
Right. That'll only be a concern on new purchases.
Right.
That's what you know. I mean, you know, your bullish nature on ground, which there's no reason not to be a concern. If interest rates would pop 3%, that's got to have an impact. Yep. You know, when you think about it, though, I mean, we were up in Trump's early years. Rates went up. Mm-hmm. So it's not like we haven't had higher rates in recent years, but yeah, it's, you go back to, I could give you a canned narrative on every land loan that was written in the 79. Good people, good farmers, that was it. Yeah, I mean, it was all based on, land's good collateral, these are good people, we'll loan the money. And, you know, I kind of look back on that and just think about how far we've come. We do a pretty good job now of being very thorough and analyzing for the benefit of our customers, not to mention protecting our stockholders. So
the lending industry has really made tremendous strides. And I think that is going to be a great underpinning foundation of land values for a long time to come. Yeah. And that's why, Jim, you made the comment you thought it was going to fall more in 1450. But I think part of the reason it did is 80% of the land in Iowa has no debt. And the debt that is out there has a degree of government that is not at max levels. Yeah. And I think those are some key features to this debt structure in agriculture that will support the industry.
And we put the lending caps in place actually in the boom back in 07 to 12 in that area. I mean, that's when the system, and not everybody in the system did it. We did in Illinois and Mid-America did at the time. Part of that was to protect our balance sheet, but it's also we thought it was the responsible thing to do for the overall market. And we didn't want to be a contributor to building a big bubble. Yep. Okay. And so we kept that in place. You know, and 3 years ago, our land caps didn't come into play much. You know, the land was in $10,000 and you know, we fell more within our advance rate versus getting capped out by the top. One thing and one story, and I promise I'll shut up unless you get more questions. But I remember a guy back when I started in Fayette County, Illinois over there. I remember a guy that was younger. He bought the highest priced piece of ground, 80 acres at the time. It was like $3,200. And that guy never lost that ground. But when I did his balance sheet, he was completely insolvent. But he always had working capital. He never lost that farm, even though he was dead broke. And, you know, so it's just, that taught me a lot about the importance of maintaining working capital. Now, I only got two of them. He wasn't married, so he didn't have that Do you hear that, Stephanie? Good, they didn't hear it. So, I always like to do that going with a group of ladies. You know, heads go up. You know, and I remember land auction in 1986. There was a 40 acres and there was getting bids on it. It was like 100, 150 or something like that. And it wasn't great ground. I'll never forget a guy in the crowd was like, "Hey, what's that, Brandon?" And they said, "It's at 150. So he bet on it. He ended up buying it I think 240 for it. He didn't even know where the ground was. He just bought it. Today, that's probably worth, if he still got it, $8,000 to $10,000.
Yeah.
I only knew that. Well, again, pleasure to meet you.
Just real quick question. As far as balance sheets, which these type of thing.
Yeah.
When it comes to the land values,
yes.
The guy that kind of taught me always encouraged me to farm, leave it, price of the pay.
Yeah.
Okay. And then when they need it, when they get in trouble.
That is an extremely conservative approach.
How do you guys judge that? I mean,
well,
so when we're doing our balance sheet at the end of the year, what value should we put down for land? Do we put it in a book or do we put?
I think the most important thing to do, I don't have a problem with putting market value on it, as long as you don't take so much comfort that to do something. I take more comfort. Okay, if my net worth goes up $1 million, but 800 of that is because I revalued my land. I think the important thing on that is we got to know how much my net worth went up because of earnings. So I've had farmers do that too, carry it. And, you know, for the longest time, it didn't matter much because land was pretty steady Eddie, right? So we run into this issue the last 10 years. In fact, I just had, there was an example the other day, somebody challenged one of our officers to finally raise their land from 7,000 an acre. It is your balance sheet. You are the one signing it. So I tell farmers, you put on there what you want. But then we have an obligation, I feel, as the lender to sift through that and make sure. The thing we can't do is take comfort in thinking that appreciation is earnings. That's what we got to avoid.
I have never seen commodity prices, stock market, interest rates as low.
Oh,
and land values as high.
Yeah.
That's perfect storm.
Yeah.
You know what it reminds me of? 1986, I was working in Quincy, Illinois, over on the west side next to the river by Hannibal, Missouri. Corn, I remember corn was $1.25, hogs were 60. A guy opened his truck door and cash fell out. I mean, the hog farmers back then, that, you know, grain was struggling, but the hog farmers then, I mean, they were making money hand over fist. And it's just, you know, we got a little bit of that in.
Back then, though, a lot of farms, the majority of farmers had some type of livestock.
Yes.
And
well, hogs used to be a mortgage lifter, is what we always called them. Hogs were the mortgage lifter. I don't know what you call them today. I mean, most of what we do on the hog side is contract barns, so they're just kind of, they're equity builders, I guess. Although I will tell you right now, the cost of building a hog barn and get what the industry, you're doing it today. You're doing it on an optimistic hope it's going to change, or
It's just an income,
well,
really an equity builder, really.
Well, you build equity. Well, it depends on your appreciation. I mean, yeah, that's slowed down dramatically. Poultry too. Well, building costs just got crazy. That's we all know. But yeah, I always tell farmers, yeah, your signed balance sheet, not me. So you put the value on there, but I think my approach on that was making sure we always did take comfort saying that's earned.
What's your real estate loans? Are they coming in cash to the table? Or
I was gonna say, these ladies handle a lot of those, so let's get them involved.
It is definitely a mix of both. And we do see, especially with our lending caps and the higher values, we are having farmers pledge additional acreage to take equity out of the ground to meet down payments, so that way they can conserve their cash. But as mentioned before, cash has not been as much of an issue this year as in previous years.
And we might taking that extra money and do that kind of separate, and then make a couple of annual payments and like, oh, release that additional money.
In my textbook of lending, I would always prefer to have cash, just because shelling out cash hurts more. There's more of an emotional than pledging an SRP line. You're still putting equity into it, but I think when you actually use liquidity, it hurts a little, and you hurt people, but it just that's what I call more
makes you think harder.
Genuine equity, right? Yeah, you feel it.
Or skin.
What's that? Skin. In both of them got skin in the game, but it just feels like we put more skin in when we put cash. But based on volatility, to their point, liquidity is king. I mean,
there's going to be some people that argue, no, you want to use your equity in your land because inflation's going up at 7%. Your interest rate is at 4.5%.
Worked really good in the 80s.
And so, yeah.
In the 80s, if you didn't leverage yourself, you were left behind until about 83. So, all right.
Thank you, everybody.
Yep, thank you.